Picture this. It is Sunday night. Markets in New York are closed. Most of the world is distracted, watching entertainment, scrolling feeds, assuming tomorrow will look like yesterday. But in the futures markets, something historic is unfolding. Silver is breaking levels that analysts said were impossible. The dollar is quietly weakening. Bond yields are rising despite slowing economic data. Equity indices are calm, almost too calm. There are no panic headlines, no emergency press conferences, just silent repricing. Here is the anomaly. Physical silver is trading as if the monetary system itself is under stress. Yet the companies that extract it, and the majority of investors, are still pricing it as a temporary spike. This is not volatility. This is a fracture. And if you are holding physical metal right now, you may be sitting on the early side of the largest wealth transfer cycle of this decade. Where are you watching from? New York, London, Mumbai, Dubai? It does not matter, because what is happening is systemic. Now we ignore the noise, we examine the math. Do the math. 2 years ago, silver traded around $25 to $30 per ounce. The average all-in sustaining cost for a primary producer hovered near $20. Revenue, $30. Cost, $20. Profit, $10. Margin, roughly 33%. A decent business. Cyclical, volatile, nothing extraordinary. Now fast forward, silver trades at $100. Costs have risen. Diesel costs more. Labor costs more. Chemicals cost more. Let us assume production costs rise from $20 to $30. That is a 50% increase in cost. But revenue? It more than tripled. Revenue, $100. Cost, $30. Profit, $70. Pause. Profit increased from $10 to $70. The metal price rose roughly 3-4x. The profit rose 7x. Let that sink in. This is operational leverage. It is not linear. It is exponential. Yet when you look at equity valuations across the sector, they are still pricing future earnings as if silver will revert back to $40. The market is anchored to the past. This is cognitive dissonance. It sees the number. It refuses to believe the regime change. Here's the trap. Investors assume every commodity rally is a bubble. They point to 1980. They point to 2011. They expect collapse. But those were speculative peaks driven by leverage and rapid tightening. This is different. This is not margin traders cornering futures contracts. This is not retail mania. This is a currency event. When a metal priced in dollars triples while sovereign debt expands and real interest rates remain structurally unstable, you are not witnessing silver becoming more valuable. You are witnessing the denominator weakening. This is monetary repricing. Mean reversion assumes the system is stable. But what if the system itself has shifted? If fiscal deficits are permanent? If debt cannot contract without collapse? If monetary expansion is the only political option? Then price does not revert. It resets. And that is where the market is miscalculating. Now look at supply. Wall Street treats all commodities as if high prices cure high prices. In agriculture, that is true. If wheat triples, farmers plant more wheat next season. Supply responds within months, but you cannot plant silver. You must discover it. From exploration to production, the average timeline is 7 to 12 years. Environmental approvals, infrastructure development, capital financing, geological drilling, mine construction. This is not a 6-month response cycle. It is a decade. And here is the brutal reality. Most of the easy deposits were discovered generations ago. Ore grades are declining globally. Each year, more rock must be processed to extract the same ounce. That means higher capital intensity, not lower. Even if a massive discovery were made tomorrow, it would not meaningfully impact supply for nearly 10 years. Price cannot fix that overnight. Now consider the byproduct paradox. Roughly 70% of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. A copper mine does not expand production because silver rises. It expands because copper rises. If global economic activity slows and base metal demand weakens, copper mines reduce output. And when copper production falls, silver supply falls with it. So we could see a scenario where silver prices rise due to monetary stress, while supply actually contracts due to industrial slowdown. That is a structural squeeze. Now examine demand. Silver is not just jewelry. It is industrial infrastructure. It is used in solar panels, electric vehicles, advanced electronics, medical technologies, high conductivity circuits. Silver is the most conductive metal on Earth. There is no perfect substitute. If the silver input cost in a product doubles, manufacturers do not simply eliminate it, they absorb it. For a solar panel manufacturer, silver is a small fraction of total cost, but it is critical. Demand becomes inelastic. If the price rises from $30 to $100, industrial demand does not collapse overnight. It adjusts slowly. Now combine inelastic demand with inelastic supply. That is not a balanced market. That is a pressure chamber. Now step back. For 40 years, institutional investors relied on the 60-40 portfolio, 60% stocks, 40% bonds. When stocks fell, bonds rose. That negative correlation protected capital. But in inflationary environments, both can fall together. If inflation persists above target, bond yields rise. Rising yields mean falling bond prices. The safe portion of the portfolio becomes a guaranteed loss in real terms. So where does capital go? Cash loses purchasing power. Bonds lose purchasing power. Equities struggle under higher discount rates. Real estate compresses as financing costs rise. The remaining underowned asset class? Commodities. Now do the capital flow math. Global pension assets exceed $50 trillion. If just 1% reallocates toward precious metals and related assets, that is $500 billion. Annual global silver production is roughly 800 million ounces. At $100 per ounce, that is an $80 billion annual market. $500 billion chasing an $80 billion annual flow. Let that sink in. Even a fraction of institutional rotation overwhelms supply. This is not retail driving the price. This is institutional hesitation, followed by eventual institutional capitulation. When capital that has ignored a sector for decades begins reallocating, liquidity becomes the bottleneck. The entire primary silver mining sector has a combined market capitalization smaller than many single large technology companies. The door is narrow. If sovereign wealth funds, pension funds, and family offices decide they need exposure, they will not move the price gradually. They will gap it. Passive index funds amplify the effect. As the sector grows in weight, funds must buy more shares mechanically. Algorithms chase momentum. Momentum attracts flows. Flows drive price. This is how melt-ups form. Not slowly, violently. We are currently in the disbelief phase. The crowd believes the rally is fake, temporary, manipulated, about to collapse. That disbelief is fuel. Because when earnings reports confirm margin expansion, when balance sheets show record cash flow, when dividends rise, the narrative changes. And narratives drive allocation. This is not emotional. It is mathematical. Margins expand. Cash flow expands. Capital rotates. Liquidity tightens. Price accelerates. Now understand this clearly. No asset moves in a straight line. There will be pullbacks, volatility, fear spikes. But volatility does not invalidate structural imbalance. If the monetary regime has shifted, if supply is constrained, and if institutional capital begins reallocating even modestly, the repricing process can extend far beyond what most participants believe possible. The key variable is not the daily price. It is the spread between production cost and market price. As long as that spread remains structurally wide, the pressure builds. This is not about hype. It is about asymmetry. When downside is limited by production economics and upside is fueled by capital rotation, the skew changes. History shows that late-cycle commodity repricings are not gradual. They are vertical. You must decide whether you are observing it or positioned before broad recognition. This is not about panic. It is about probability. It is not about fantasy. It is about flow of capital. The unthinkable is not that silver rises. The unthinkable is how few are positioned if it does. If a generational capital migration is underway, from paper promises to tangible assets, then the early participants are not lucky. They are aligned with the math. Do not rely on emotion. Do not rely on headlines. Rely on arithmetic. because arithmetic does not negotiate. This is not financial advice. This is survival data. And when the system reprices, it will not ask for permission.